I'm Kathy White.
And I'm Chris Basom.
And we're with Your Money Matters, and we're here to talk to you today about HR1 and how it affects the mortgage interest deduction and property taxes.
What is HR1?
HR1 is the new revenue code that's gone into effect, effective January 1st of 2018.
Woo! So does this affect my 2017 return?
Nothing we are talking today will affect your 2017
So I'm okay
tax
for 2017.
Really,
I'm just worried about 2018.
Yes.
Okay. So here's a Schedule A. This should make you break out in a cold sweat. This is the beginning of a 2017 tax return. The interesting things to note here, what we're going to talk about is interest paid deduction and the taxes that you paid deduction. What happened to taxes?
The property taxes, but the deductibility of, they're calling it SALT, which is interesting. It stands for state and local taxes. So what does that mean? It means state income tax withholdings that you have on your W-2, as well as the property taxes that you're paying on your primary residence. And what happens is if I can just point to Schedule A here, we have our state and local income taxes is on line 5 of the Schedule A, and then we have our property taxes, which is on line 6 of our Schedule A. These combined go on to line 9 currently on your Schedule A, and this will be limited in 2018 to $10,000.
And you mean all taxes that I pay that are not federal taxes?
This whole amount.
Go right there.
So let's say you're not a W-2 employee, you're a 1099 subcontractor, and you pay quarterly estimated taxes to the state of California. That will also be limited with your property tax to a $10,000 limit for 2018.
So I get 10,000 of that and 10,000 of that, so I get 20?
No, you have a limit of $10,000 total.
So does it matter if my property is in Nevada? No. Well, we're trying to drive home here.
Total state.
Total
state.
State and local taxes, $10,000. Doesn't matter how many properties I have.
Nope.
Doesn't matter how much income tax I pay. Doesn't matter how many cars I have and I pay DMV fees on. Doesn't matter how much state disability insurance I pay. Everything in that box, line 9, will be the greater of $10,000 or $10,000. It's $10,000. That's it. It's 10 grand. Okay. Then what happens to interest?
So now our home mortgage interest and the points that we're paying, it is now been limited to $750,000 total acquisition debt.
But it's primary residence and vacation home, as long as the debt is not in excess of $750,000.
Total, combined on all residences.
Right,
yes.
All residences. So that means that if I bought my house 10 years ago for $1 million and I still owe $900,000 on it, I haven't refied, I haven't changed my loan, do I still get my $900,000 mortgage deduction?
There are a couple of exceptions on the $750,000 mortgage debt indebtedness. The exceptions are if you were in contract and you closed before the end of 2017, you are grandfathered in with your mortgage debt. Also, if you had your mortgage prior to December 22nd of 2017, your mortgage in excess of $750,000 would still be deductible up to the $1.1 million, which is the old revenue code of mortgage indebtedness up to $1.1 million.
And did that include my HELOC?
It did include equity lines of credit, yes.
Okay, so as long as my equity line of credit and my first trust deed have been in place for a long time, and I haven't changed them, I could have up to $1 million to $1.1 million in total indebtedness. But if I'm talking about a brand new house that I'm buying right now, $750,000.
Yes.
Okay. And how about my HELOC?
Unfortunately, equity lines of credit are no longer deductible, and it is acquisition debt. So if you took out a loan to go to Europe or to pay off a car, those loans are not deductible. But if your loan is against the house, an acquisition, or any remodels that you did, and it was property specific to your primary residence, up to $750,000 is deductible.
Okay, I'm right in the middle of a refi right now, but it's a rate and term refi. I'm not going to take any money out. And so I'm just taking my $900,000 previous debt, and I'm going to refi it rate and term into a new $900,000 debt. Will that be deductible?
Well, it's kind of an interesting question because we're still waiting to hear a little bit more guidance on how the IRS is going to do that if you had old debt that you're refinancing.
The general feeling is, as long as it doesn't increase the debt, as long as we're doing a rate
If
and term refi.
if you had 900,000
Right.
and then you're rolling in all of your closing costs and all of your fees, that would not, then you would owe more than the 900,000, which would be your existing debt. So the difference would not be deductible, but the existing, we're under the impression it would still be deductible.
But how are they going to know? Right?
Shall we show you the next form?
So this is a 1098. It's a really big one, but this is the 1098. This is how the bank reports the interest you paid on your mortgage. What's interesting about it is, in the past, we would have the bank's name, your social, their tax ID number, and we'd have the amount that you paid in interest. And that's right there, the mortgage interest received. A couple of years ago, we started to see new numbers on this form, and they appeared right here in box 3. Outstanding mortgage principal as of 1/1/16. Mortgage origination date of 12/21/2011. So the IRS is now gathering the data that they need to nail us if we try to play with these rules. This is brand new to us a couple of years ago. I think it was 2015 was the first time we saw this. This information will be transmitted to the IRS right along with the interest you paid. So they'll be able to tell when you started that mortgage and how much that mortgage balance is, because literally interest rates determine how much real interest we had, right?
Yes.
If this was a 10% interest rate, we'd have had $31,000 in interest that year. Now, would I be limited to $31,000? Or do I get all my $31,000, or do I only get $10,000? It's mortgage interest.
Mortgage interest up to the indebtedness of $750,000.
And that's
so
what's
this
crazy.
particular one with $316,000 is their mortgage interest. Their mortgage principal on here is $316,000. So the mortgage interest of $9,198, they would receive the full deduction.
And that's what's weird about this. The IRS sometimes will cap the amount of deduction, like they did with taxes. Sometimes they cap the amount we can owe. Interesting. So maybe in this case, not as important to buy down a rate because our rate is still okay and our interest isn't excessive. Maybe it makes sense to buy down the rate. This will be a discussion that we've not really had in the past, but we're going to have more now.
One thing we haven't talked about yet is rental properties. So on rental properties, probably want to know if your mortgage interest and your property taxes are going to be limited on your Schedule E for rental properties. And the good news is Schedule E, which is where we report our rental income and all of the expenses, has not been affected by the new tax code.
Not as far as interest and tax deduction go. Okay, but I think
the full amount of your mortgage interest and the full amount of your property taxes will be expensed on your Schedule E against your rental income.
So I could owe $3 million on my rental and still get all the interest write-off, and I'd get all the taxes regardless of how much they are, as long as it's on a rental.
And business property is the same way. So any kind of rental properties, business property, if you have a commercial property, multi-unit apartments, everything remains deductible, whatever the interest on the mortgage is for that, and your property taxes remain the same, no changes.
Aha! Then that brings up another question. If I shift debt between my rental properties and my home, I could do that to make the outcome of this more successful for me, right? If I owed nothing on my rentals, or let's say I owed a ton on my rentals and I owed nothing on my house, I could shift $750,000 over to my house, new loan there, write that interest off, and change the deduction here, couldn't I?
And you can do the opposite as well. Let's say you have a rental property that you have only $200,000 worth of mortgage debt on, but it's really worth $1 million. You could take out that additional $750,000 of mortgage against the rental property, and you could deduct it.
Well, you know, we're not visiting our vacation home in Palm Springs hardly at all these days. Ooh. And
you could convert that now to an Airbnb, make it a rental property, and then your mortgage interest would now be deductible as well as your property taxes.
Because right now, in 2018 going forward, it won't be because I'm above my 750.
Yes.
So if I change the type of property it is, I can change the debt.
Yes, you can.
Yay.
And still write it off.
Yay!
Absolutely.
Okay, cool.
So,
a couple of tax geeks talking about HR1. Thank you very much.
I'm Kathy.
I'm Chris.
Have a great day.